Imagine a country becoming the world's second-largest economy. A nation so powerful that experts believed it would soon overtake the United States. Now imagine that same country losing trillions of dollars in wealth, watching its stock market collapse, its real estate prices crash, and its economy remains stuck for decades. This isn't fiction. This is the story of how Japan lost trillions of dollars. In the 1980s, Japan looked unstoppable. Its companies dominated global markets. Its technology amazed the world. Its economy was growing at an incredible pace. Many believed the 21st century would belong to Japan. But beneath this success, a dangerous financial bubble was forming, a bubble so massive that when it finally burst, it would trigger one of the greatest economic disasters in modern history. After World War II, Japan achieved what many economists called an economic miracle. From the 1950s through the 1980s, the country experienced extraordinary growth. Japanese companies like Toyota, Sony, and Panasonic became global giants. Japan's exports flooded international markets, and its manufacturing efficiency became legendary. Then, in 1985, a major international agreement known as the Plaza Accord changed everything. The Japanese yen strengthened dramatically, making exports more expensive. To prevent economic slowdown, Japan's central bank lowered interest rates. Cheap money began flowing through the economy, and that is when the bubble started to grow. With interest rates at extremely low levels, borrowing became easy. Banks handed out loans generously. Businesses borrowed heavily. Investors poured money into stocks. Ordinary citizens rushed into real estate. Everyone believed prices would keep rising forever. By the late 1980s, Japan's asset prices had reached astonishing levels. Tokyo real estate became some of the most expensive property on earth. The Nikkei 225 surged to nearly 39,000 points in December 1989. The country appeared wealthier than ever before. But there was one problem. Much of that wealth existed only on paper. Asset prices had become disconnected from reality. Concerned about overheating markets, Japan's central bank began raising interest rates. The flow of easy money slowed, and then the bubble burst. The collapse was brutal. Stock prices plunged. Real estate values began falling year after year. Banks suddenly found themselves holding enormous amounts of bad debt. Businesses that had borrowed heavily struggled to survive. Investors watched fortunes disappear almost overnight. Trillions of dollars in asset value vanished. Yet the most surprising part came afterward. Most economic crises eventually end. Recoveries begin. Growth returns. But Japan's recovery never seemed to fully arrive. Years passed, then decades. Economic growth remained weak. Prices stagnated or even declined. Consumer spending slowed. The country entered what economists would later call Theory 1. The bubble was simply too large. Many economists believe the bubble had grown to such an extreme size that its collapse inevitably caused long-term damage. When trillions of dollars in wealth disappear, households and businesses become more cautious. Spending falls, investment declines, and recovery becomes painfully slow. Theory 2. A banking system in crisis. Others argue that Japan's banks were the real problem. Many banks delayed recognizing bad loans and avoided addressing their financial weaknesses. As a result, credit remained restricted, slowing economic recovery for years. Theory 3. Demographic challenges. Japan's population began aging rapidly. With fewer young workers entering the workforce and more retirees leaving it, economic growth naturally slowed. A shrinking population made recovery even more difficult. Theory 4. The deflation trap. Perhaps the most famous explanation is deflation. As prices stopped rising and sometimes even fell, consumers delayed purchases, expecting better deals later. Businesses reduced investment. Economic activity slowed further, creating a vicious cycle that was incredibly difficult to escape. Onomike recovery for years. Japan's story is more than just the story of one country. It is a warning about the dangers of financial bubbles, excessive speculation, and easy money. In the 1980s, Japan was viewed as the future of the global economy. Yet, within a few years, trillions of dollars in wealth had disappeared, and an entire generation experienced economic stagnation. Even today, economists continue to study Japan's collapse, because the question remains as relevant as ever. If one of the world's most advanced and disciplined economies could fall into this trap, could it happen somewhere else again?